So, welcome to the episode of the Flow podcast, where we talk about the market structure, institutional market structure with industry leaders. And today we have Duncan, who is the co-CEO of TP ICAP's digital assets arm. Duncan, it's great to have you here.
Yeah, pleasure to be here. Thanks, Costas.
Thank you. Let's maybe start with a little bit of a background, right? You've been with TP ICAP for like ages. And you
My entire career.
Exactly. Like you worked within like different asset classes. So maybe you can tell the audience and set the stage, sharing your background from all the different asset classes.
Sure. I was a physics grad, so I came into finance in 2008, not knowing anything about finance at all. And the way it was ICAP back then, but the way ICAP did their grad program, you got to rotate around different desks. So I sat on the sixth floor, which is where we had our electronic trading businesses like BrokerTech and EBS, and went around a variety of different desks, including our, like dollar swaps, commodities, etc., and settled in equities on a equities derivatives desk. So I spent 12 years as a voice broker, working my market, with getting to know the traders that traded that market very, very well. And then in 2017, stumbled across the Bitcoin white paper. Definitely took me back to some of my physics days at universities. Reading that sparked something in me and one of the guys I was broking with, who's my co-head of the business now, Simon Forster. And yeah, just made me realize that was the area I wanted to dedicate the next chapter of my career into. So we started on a plan internally to try and create a digital assets, blockchain, crypto-based part of ICAP.
So you basically sparked that interest within the TP ICAP.
Yes and no. I would say at that point in 2017, there were a variety of people across the organization that were probably thinking something similar. I mean, it was when Bitcoin went to 20K for the first time. And I'm sure across a lot of traditional finance businesses, people were going, hey, what is this? Should we pay attention to it? So our now CEO set up a working group and brought together different people from across the organization that were interested in crypto to meet monthly and say, what do we think this is? What could it mean for TP ICAP? Should we look at it in some way? And that working group probably had about 60 people on it. It was quite big. We had senior management, people in front office, middle office, and support, different people in Asia Pacific, London, New York, all over the world. And then in 2018, when Bitcoin dropped back down to, I don't know, went to like 2,000 or 3,000, something like that, the working group went from 60 to 12.
But like only the strongest remained.
Exactly. There were a core group of us that I think had quite a long-term view and passion for crypto and blockchain. And we persevered onwards to try and start a business.
Nice. It's a nice story, actually. Like, it proves that those who believe, they actually get successful, right? And like, look where the TP ICAP's business right now. I think across all of the TradFi institutions, we probably have one of the most developed digital assets arms. And let's chat more about the structure of the markets and some parallels with you've worked at like on the equity side, the commodity side of business. So like, what are the parallels that you see on the market structure between those asset classes and crypto?
I think we were talking before this. I think when new asset classes evolve, they take features from some of the other asset classes from day one, and have their own kind of unique properties relating to the underlying product. I think crypto has both OTC markets and electronic traded markets, and given when it started, electronic trading was core to that asset class from day one, which most other asset classes, that's not the case. I think I think it was a technology and business-led asset class. And I think it's taken some time for other parts of what makes up the product to catch up. So I mean, product in traditional finance is not just the technology and the method of trading. It's also like the rule books, the legal, the compliance aspects, market control frameworks.
Yeah, of course. Yeah.
Which is the overall product. And I think...
And in crypto, it emerged from retail, which had no idea of like what are those market abuse practices that you'd see in traditional markets.
Yeah, so I would say crypto has always been quite at the bleeding edge of technology, central limit order books, and now with what you're doing at Finery, ECNs in the market, that's been quite early in the asset class. But yeah, I think it's taken a while for the structures around that to get up to scratch of what we're used to in traditional finance.
Yeah. And you once called crypto a Trojan horse for the blockchain adoption. And besides trading, where we don't really see a lot of like pure on-chain trading adoption, what other areas within the capital markets, especially institutional capital markets, where do you see crypto is actually driving the blockchain adoption?
I'll stand by that, by the way. I do think it is the Trojan horse for traditional finance. Look, if you roll back maybe like 4 years, the dominant train of thought across traditional finance was blockchain is going to revolutionize finance, but it's going to be on sort of private chains or enterprise blockchains. And there were a lot of industry efforts, whether that be private companies or consortia or blockchain teams within banks, pushing that as a future for the industry. What we observed from having, and I think this was one of the benefits of like having of growing and innovating, but doing it with live products where you're actually in the market, is that really the demand we saw from customers was for crypto. And this was something that they couldn't access elsewhere. And by wanting that exposure, like this is why we want to trade something, they had to get their heads, and they being clients in general, had to get their heads around, okay, how does a token work? How does digital custody work? How do we hold this product, which is different to the other products that we're used to? And in truth, if you were trying to pitch, and we certainly did some of this in terms of market sizing and assessing customer demand, saying, hey, do you want to trade a bond as a token, or do you want to trade a equity as a digital asset instead? And a client would say, well, why would I do that? And you say, well, the market's going to be more efficient, it's going to be cheaper, it will settle quicker.
Yeah.
And the client would say, well, can I do that now? And we'd say no, but if everybody in the market agrees to move on to this system, we'll realize these efficiencies. And most clients go, well, tell me when that's happened and I'll come and get involved. Whereas crypto tokens, there was client demand for that. People saw wealth creation and wanted to participate in that. And I think that forced firms to go on that evolution and that journey to like understand blockchain tokens. And what I think is starting to happen now is once you've gone through that journey and you suddenly realize you have digital custody and you understand how to hold a token, it then becomes easier for, okay, well, if that token is actually a money market fund, or that token is a equity, then sure, there's not much of a lift there. It's like, well, I'm already holding tokens. I don't mind holding, traditional asset classes in token form. And suddenly the barrier to entry is dramatically reduced. So,
but you still need to have like all the pieces of your infrastructure, like the custody part, like the prime broker, like all the rails from your TradFi world needs to be replicated or needs to be supported by your existing institutions. So where do you see we are in that adoption cycle? like how far we are from ticking all of those boxes
Hmm.
from all the major TradFi guys.
I actually asked Copilot this yesterday.
Yeah.
So in the formation of a wholesale market, how far is crypto along in the journey? And Copilot said we are 3 to 4 years into a 10-year cycle. So
Well, that's optimistic from like depending on the angle you're kind of looking at it, right?
yeah, and I mean, wholesale market, I think, is when big institutions really move in because they can, it's business to business trading where you can trade in size amongst your peers. And I think that, yeah, what are the ingredients for that to be in place? Appropriate regulation. We're midway through that journey, I think. We won't harp on the different sort of regulatory frameworks that have come out, but there are some now. There weren't 3 or 4 years ago, but we don't have them everywhere. We're still, I think custody has become, I wouldn't say commoditized, but there are fit for purpose institutional solutions for custodians out
It's
there
solved
now.
as an issue.
It's
because
solved as an issue.
I remember like also 4 or 5 years ago, like there were a few crypto events and custody was probably one of the most unsolved issue. And then literally 2 years after that, we now saw a range of institutional grade, both like either qualified custodials or the self-custody solutions that actually emerged. And now it seems that this issue is gone. And it's only about like adoption by the major guys of either like just doing some M&As or just purchasing that.
Doesn't come up at conferences a lot anymore, does
Yeah.
it? On all the panels.
Yeah.
I would say there's still most traditional financial firms, so like most institutional investors, I still think there's a gap in terms of the dominant custodians they use probably don't have crypto as part of their business, but I fully expect there to be a lot of M&A in the next few years. Probably both ways. Some digital firms maybe buying small sort of custody banks and becoming a full functioning financial services offering, and then probably some of the bigger custodians doing some acquisitions. But yeah, that's on the way to being where it needs to be for a proper functioning wholesale market. I would say one of the big areas that comes up a lot of clients is prime broking.
100%.
That one does come up at conferences at the moment.
And we did see a pretty decent M&A.
We have
a few months ago. Yes.
But I think the PBs that big trading firms, buy side firms, and institutional investors tend to use in traditional markets are still a ways off being able to support crypto. And there are lots of sort of PB offerings within crypto. Probably not many of them have the full suite of services that a traditional PB.
Well, prime brokerage is an overused term in the crypto space, and we can call like a dozen of primes in the crypto space which don't really have a lot of those prime services that we're used to in the traditional space. But I think also with the market maturity and the balance sheet that they might build up over the next few years, and also with M&As, hopefully that will change.
Yeah, and probably the final area I'd say that needs some work, and I'm sure there are others, but the sort of exchange connectivity and OEMSs, they're typically in crypto, they're crypto native firms. And I would say that our LiquidNet business, which has connectivity into over 1,000 buy-side firms, and I think it's somewhere like 20 of the major sort of vendors that do that API connectivity. A very small percentage of those traditional ones have crypto connectivity. So there's still if you're a institutional investor or a trading firm, your choice is my current OEMS doesn't support crypto, so I need to get a separate vendor just for this asset class.
Separate screen,
and they don't like doing that.
They
prefer
too many screens already.
Prefer for it to just be part of the existing one. So there's probably some work to be done there on connecting those, I would say.
I agree. And we briefly discussed also like before the podcast of how the flows are moving like across
Mm.
different venues, also especially in the light of M&A, in the light of the market structure. And I've been chatting with a few of large market makers. We were discussing the spot side of things, and they shared quite an insightful observation that a lot of the flow is migrating from tier one crypto native exchanges into either decentralized space or and that's actually where a lot of the retail demand is going. Like all the crypto native clients, with the adoption of self-custody wallets and the integration of those self-custody wallets with DEXs, kind of the volume is migrating on chain. And then the second observation is the OTC. Also, with more and more regulated institutions coming into the space, they see a more efficient way to deal is with the OTC, and then like also the regulated exchanges, I guess, also bringing some of that flow. So how do you see that? Do you see that from like your perspective? Did you discuss it with any of the LPs? I guess that was quite an interesting insight, especially on the like on-chain side.
Yeah, I would say in general that on-chain applications are still a bit outside of the general level of understanding of most financial services firms. Look, I think individuals within the firms have done their own research and understand what's going on there, but
explaining it within the organization,
institution-wide, and when we're talking about how you roll out product, that's a collaborative effort across business plus all of your control functions, compliance, legal, risk, operations. In order to mobilize a new product, you need everyone in sync on that. And I would say that in general, my observation would be that on-chain trading and look, there are some examples of like particularly hedge funds that have done that often through maybe a slightly outsourced trading vehicle, and they are trading on chain for sure. But in terms of the large majority of financial services firms, I'd say that's probably a little bit outside of our. We just haven't done the due diligence on it yet. I'd say in terms of flows, I think the market structure is going through a real shift at the moment. You have onshore and offshore venues where liquidity coalesces, and that often there's been a flux between offshore and onshore depending on how pro-crypto certain administrations are. I think that kind of dovetails with regulated or unregulated venues naturally. But I also think the really interesting point is around traditional venues. So the traditional exchanges or OTC venues, of which we're one, that have built kind of crypto products. So whether that's futures and options on the CME, whether it's the offerings that TP ICAP have built, whether it's the ETF options and ETF products that are now dominant in the market, and the native venues, and how liquidity sits across those, because a lot of the native venues, we've seen IPOs recently in the market, and IPOs are ways of people on the cap table realizing the gains, but also they're stamps of legitimacy, and certainly something that professional trading firms look at when they're thinking about the risk of the venues that they're trading on. So firms like Coinbase, etc., that have gone down that route of becoming public companies, it does lend legitimacy to their business and gets people comfortable dealing on them. And I think that there's this natural evolution of some of those crypto venues getting that stamp of authority and being vetted by the kind of big listed exchanges, and particularly in the US, and that's a key requirement for them to start servicing institutional trading firms and investors. So we think about that a lot at TP ICAP in terms of our role in the market, and how we can service our client base and where liquidity will sit across these different venues.
But I believe you are a clear beneficiary of like a tightening regulation and this migration of the flow from the offshore exchanges into like a proper regulated structure. So that's 100%.
I think it will grow the market for everyone.
Yeah.
I think there are some key requirements for the asset class to mature, and I think why everyone understands that's important is because a rising tide lifts all boats. If we go from a $4 trillion asset class to a $40 trillion asset class, that's going to be good for everyone that's a service provider in the industry. So
100%. So like right now there are a few hundred centralized exchanges, centralized matching engines. There are like a few hundred decentralized exchanges. If we look in 2-3 years horizon, how do you see, will the market be more consolidated, or we can see even more fragmentation there?
it's a really good question. I think there will definitely be consolidation for the wholesale market and institutional flows, but I'm not entirely sure how the market structure effectively ends up, because there is a kind of, if you think about FX market structure with the hub and spoke type model, there's n number of different retail brokers that service retail customers and provide matching services in a very localized manner in certain cities or countries, and they all feed and aggregate and feed into the global wholesale market. And to some degree, you could argue that these crypto exchanges, a lot of them are quite localized in terms of the regions that they service, and potentially DeFi platforms can be at the extremities of the hub and spoke model. And then when you get to large size business to business flows in a wholesale market, that consolidates around a few key venues where, almost like in FX, you have the primary market.
Yes, the price discovery, and then like everyone feeds into that.
Yeah.
But I think what's really different in crypto, since it emerged as a retail asset class, and then it basically consolidated enough volume and enough flows for the price discovery to happen directly with those retail exchanges. And then all the market makers, all the institutions, they're actually also using some of these tier one offshore exchanges as they're like just offloading their risk there, instead of offloading it on some of those wholesale marketplaces that basically like Finery Markets. When we started 6 years ago, this was our thesis. And when we started to dig into the market deeply enough throughout our journey, we noticed this is a clear difference in the patterns of how the FX markets emerged, like from the banks being the large market makers and the dealers into creating this inter-dealer marketplaces, versus crypto, where you have those large retail hubs, which then emerged into the hubs for market makers to also offload their risk. And it's really interesting how we'll see that dynamic changing in the next few years. Like, what's your take?
Well, I just think things like a national sort of best bid and offer are going to be important, because best execution.
Is that possible within the next few years in crypto? I mean, like US equity
Probably
market
not.
is like struggling with that, even with their still huge but like way less fragmented market, right?
Yeah.
And now we're talking about hundreds of exchanges, which is 24/7, and this looks like mission impossible for.
Yeah, it does, but I think increasingly best execution is going to be a forcing function on the market. And I think that as that, and that dovetails with the more institutional investors and trading firms that come in that have sort of fiduciary responsibilities to their clients, they're going to be requiring that of the venues that they execute on. And that forcing function, I think, is going to drive liquidity to coalesce around certain venues. Whether we get like a industry-wide organization to kind of put together a best bid and offer.
Yeah, that's the whole point, right? Because in like we know that there is a primary market for US equities, basically, which is obviously US. There's a primary market for European equities, which is Europe. And when we talk about crypto, it's fully global. So there's not a single regulator who has the mandate to create this NBBO. So that by itself, like the industry understands, and I guess the regulators understand that this is an important thing to happen. But if you start to consolidate that, you can then further fragment the liquidity because you can only control your own regulatory framework and basically your own jurisdiction. So that's an interesting kind of chicken and egg problem to some extent. Yeah. But anyway, yeah, let's move on from the trading side into the like not electronic trading, but also the voice, right? Because you can collect the NBBO from the like electronic venues, but TP ICAP is also doing like a lot of the business on the voice and chat. So how do you define like what are the pros and cons of like each types, and like what is the difference of the client preference when they choose between voice and electronic?
Yeah, it's a great question, because I think the lazy industry narrative is that electronic trading will take over financial markets, and the role of a voice broker, sales trader, human interaction is antiquated and to be consigned to history.
But Richard Thaler got the Nobel Prize precisely because he mentioned that human behavior should not be underestimated, right?
Indeed. And I think that what we've seen across our wider business is where they're bespoke products, where liquidity isn't standardized and trading isn't standardized, always lends itself to a level of discretion that requires some form of human interaction. And I think that one of the things our general business has really pushed on is using technology to make our brokers more informed and make them able to make better decisions, be able to do more in their day-to-day job, because a lot of things have been automated, etc. Yep. So I think as crypto matures and we start to see activity, like trading activity around reference rates, packaged products where you're looking at one leg versus another leg, vol-based products where a lot of structures that clients want to trade are not that liquid, and there is still a role for a broker or someone to generate liquidity. And I think people underestimate the fact that traders can be, the role of a broker in generating liquidity is not just, okay, where do you buy or sell something? What is your price on it? They can encourage traders to be more open about where they would actually get something done, right? Yep. In terms of, let's thought experiment, an automated AI bot says, what is your bid on this? You get one price. You speak to a broker who's a very good friend of yours and you trust, and you say, okay, this is my price, but I actually would trade at this price, but don't show that to the wider market, but have it in mind so that that is where I would actually get something done. You then have a very different conversation with, say, a seller or the other side of the trade. And it's like, look, my bid is this, but here's some color. If you can show me something in this range, I think we actually get a trade done. I think there's something to do. That doesn't always, but often leads to things printing, and you are generating liquidity off the back of that. Whereas with the AI agent, suddenly your bid and offer just don't move, right? It's like, well, this is where I'd buy, this is where I'd sell, but no one's taken that step to actually close the
negotiation
gap. No negotiation, right? And I think people forget that there's a huge amount of OTC broking going on in crypto. It's not exactly the same, but a lot of that OTC desks, a lot of these crypto firms, they have people on seats speaking to end clients, making two-way prices. And yes, unlike a sort of interdealer broker where we don't take principal positions, we're always matching a buyer with a seller. In those OTC desks, it's often, the house can take positions as well, for sure, although they love matching buyers with sellers and not taking any risk on the book. But there are physical people out there working markets, and I think that's particularly important in products that are not standardized, particularly vol-based products,
fragmented
fragmented markets. And we're starting to see some of those things, like whether it's basis trading. A lot of institutional investors at the moment are looking at the ETF versus the CME and looking at profiting and closing that arbitrage, and these products require there are different ways of trading it. You can go directly into the CME order book or the ETF order book and hit each independently. You can also say, like, I'm happy to take one side of this, and if there's someone who's willing to take the other side of it, and that requires some level of discretion and broking. So
so if you have like a general idea, what do you think is the split between the voice part and the on exchange or like electronic part right now?
Across the industry?
Both across the industry, and if you can share within the TP ICAP as well.
Yeah, I mean, across the industry, it's really hard to tell because typically all the reported volumes are out of the centralized exchanges or DEXs, which is all electronic trading.
Which sometimes report the wash trading.
Yeah, I'm sure there's a lot of that too, which is a concern that we definitely get asked about in terms of when people are observing the market and trying to decide whether to enter the market. I think it's a lot harder to understand how much volume is being done OTC, and by OTC I mean voice driven, where it's not reported on any exchange or blocked on any exchange. So I wouldn't, it's hard to guess in the wider industry, but I would say the OTC nature is massively underestimated. At our side at TP ICAP, we have two sides of our business. Our spot business at the moment is exclusively electronic through our spot venue, and that's largely because Bitcoin dollar, ETH dollar is a very standardized product. And the voice side of our business, the broking desk, which is predominantly vol driven, so looking at options on crypto, and now some Delta One type strategies, that is exclusively voice at the moment. So for us, it's 50-50 in terms of how we split our business.
Gotcha. And let's talk about like back the market structure. TP ICAP has operates a variety of different matching engines across the different asset classes. So what are the key insights that you kind of reused, and what inspired you to build your own club within the digital asset space?
Yeah, it's a good question. I think actually we're in the process of consolidating our clubs as an organization. That's something our technology teams are working on across the broader organization. I'd say one of the things that we've learned through building this business is, and I think this gets under discussed in the industry, is that actually the real innovation with crypto is the post-trade side. It's, the electronic trading, clubs, ECNs, API-driven trading, that really materially revolutionized finance over the last 20 years. But it was largely sat on top of a post-trade that was that's iteratively improved, but it's
still
not
a lot of legacy. It's just from the old days. It's all like even though it's like not T+3 anymore, but all the processes behind that, they're still there.
And there's a lot of reconciliation between, and a lot of discrepancy between different systems. And I think the thing that we find exciting about on-chain assets and token-based instruments in general is that it is a real step change in terms of post-trade. You can transfer value over the internet. It can be relatively instantaneous. It is, and it's a structure that can be applicable to a variety of asset classes. And I think there's a lot of lessons for crypto to learn from ETFs, because the reason why ETFs have become so popular is because it's a very standardized route to exposure across different asset classes. You can hold a commodity ETF, a individual equity ETF, you can hold a basket of equities, but it's in one standardized product in a brokerage account that is very easy for investors to utilize. And I think, I've done I think probably if you'd asked me 4 years ago, I would have had a view that, token-based infrastructure will become the destination standard for traditional finance. It may be going to take 10 to 20 years, but I think the dominant back office and post trade of finance will migrate to the system, with crypto as the Trojan horse and increasingly other asset classes. Obviously, tokenization and creating these products has taken longer than probably the industry expected. But I also now have evolved my thinking to think that actually it's potentially a complementary structure with a different end investor. You know, there's kind of a generational difference to how investors get access to financial investments. You know, the ETF generation is probably my generation, and there's probably for the younger generations out there, holding tokens in a digital wallet is going to feel like their way of accessing financial
100%.
product. And like, there's no surprise to me that the big asset managers have gone heavy into tokenization, because they're facing customer retention challenges. How do you market yourselves to the younger generation if you're a 100-plus-year-old, often stuffy asset manager? But if you offer blockchain-based instruments through a digital wallet, it's a way to appeal to the younger generation, I think. So we're toying with the idea at TP ICAP about, okay, what does tokenization mean in terms of other asset classes trading as tokens? Is this a different distribution mechanism? Are we going to have fintech apps, retail aggregators that are blockchain based, that are the end investors for these products, and they'll access exposure to money market funds as a token, but traditional investors may stick with brokerage accounts and ETFs? Or will we generally over time migrate to tokens in the future? So I think, rather than necessarily, I know your original question was around clubs, and the thing that we've built up a lot of institutional knowledge on is that post trade and how that could impact our other asset classes.
And to your point about those different generations, I've read a few reviews from DGen clients trying to open up a couple of brokerage accounts with the likes of Robinhood and the other brokers, and then when they try to transfer their shares between different types of between different brokers, then they faced this real world post trade settlement issues where it can take months with all the extra paperwork, and this literally is insane. If you can think that just transferring your coin from one wallet to another takes you a few seconds or minutes, and then looking at this post trade, it is a mess. And do you guys plan to support any tokenized equities in the near future, if we talk about specifically security tokens?
Short answer is yes. One of the things that we have as an organization is a lot of traditional regulatory licenses in lots of different jurisdictions for the trading of traditional assets.
Places you already way above anyone else in the space.
And what we've done over the last 5 years is build institutional expertise in how to provide trading services in a token, and the connectivity and plumbing required behind that. It's just, at the moment, that's only on Bitcoin and Ether and the major cryptos.
But it's agnostic, I believe.
That's certainly how we view it, and it's about stitching together, what we do very well, which is operate trading platforms and coordinating liquidity, and doing that in a sort of regulated manner, and then stitching that with a new post-trade plumbing. The key thing is client demand,
of course.
and mapping that with what the sequencing of different asset classes. Money market funds have come after stablecoins because there was a need for yield.
The demand is probably coming from those DGen clients that are used to get everything within their wallet, and then they just want to also have their Tesla or Apple stock next to their Bitcoin, and make it self-custodial, even though it's still, in the end of the day, it's held somewhere in State Street BVH or whatever, but still, at least they can have it within their wallet and move it around easily. So do you see maybe the demand from these type of retail brokers?
There's that. I think a simple picture of how it could look is, you've got the major cryptos, you're able to hold stable coins for payments. You hold some money market funds for additional yield when you long hold fiat on chain. And then, what do people want to invest in? The major large cap equities, probably some index-based equity products, maybe some major bonds or gilts or treasuries, etc. And it generally looks like a financial investment account. So there's that, but there's also on the capital market side, banks are looking at how they use on-chain collateral for intraday settlement and making it more efficient between them in terms of managing their exposures against each other. There are commodities firms looking at using stable coins in trade finance to simplify their workflow. So there's pockets of application of this technology in these products, and in truth that's barely even started yet. So there's going to be a huge amount of the next 5 to 10 years I think are going to be very exciting in finance.
One thing which really excites me and also concerns me about especially tokenization of the equities is it seems we will see way more fragmentation issues, because if we look at the equities, right, there's a concept of depository seed, where an issuer selects an issuing bank which owns the DR program, and then you basically have like almost full fungibility. You have clear rules that this is the issuer that holds the mandate for the DR. And then if we look about like on how the tokenized equities right now are emerging, we see that there might be multiple issuers which then create their own tokens. And I'm not certain whether fungibility is possible between those. So it seems that I now have not only 50 different venues where I can trade my Tesla stock, but I now have also 10 different issuers that issues different wrappers on different flavors of that. So do you see that as a major challenge? And like, what do you think is the solution to that?
Yes, I do. But I also think it's part of the evolution. Look, the ultimate end goal is native on-chain issuance of equity, where the company issues equity directly on chain.
Yeah, with a local registrar supporting that,
Exactly.
which I guess
and
this is the ideal
end game. But there's a lot of challenges there in terms of how do you manage voting rights, how do you manage the dividend payment, how
corporate
actions, etc. And that there's a reason why that hasn't been done yet. I think that some of the ones we've seen in the market recently, where it's effectively a derivative, i.e., it references equities held elsewhere.
CFD.
CFD derivative. It's in that vein. Look, it pushes the industry forward, and I think it's important because it's started a conversation on this. It's setting in people's mind that this is the direction of travel and this is going to be possible. But in the short term, like, read the T's and C's, because these things are often held in special purpose vehicles offshore. There's a lot of risk to an underlying investor, 100%. And it's important that they understand that. And that's probably missed. And it's not a good look for the industry when these get issued and the company that goes, we do not sanction this, we know nothing about this, this is not our equity, right? But long term, I think it's exciting, right? You might solve some challenges of like private companies that investors can't, access isn't democratized, and people can't, particularly retail investors can't get access to that until they're, some of the challenges of why IPOs come so late, and a lot of the value appreciation has been lost to individual investors, and it's just with big VCs, etc. So some of the things like that, I think we can try and solve as an industry. I have to say, like, that's probably one of the things that really fascinated me about digital assets in general when I was if we go back to when I was talking about 2018 and when we first started looking at this, one of the things that I like recognize now is that I'd probably become a little that there's a lot of specialization in finance, and sometimes one of the things I observed is people forget the why of what they're doing. Like, finance as a whole has become optimized around value.
What actual problem are we solving?
And it's like financial markets are there for price discovery, the flow of goods across the world, so companies can raise money, so they can finance themselves. But actually, we're so hyper specialized. Individuals working within different parts of finance, like if you are a trader of FX spot or you are a broker of structured derivatives, certainly in my case, you sometimes forget the broader system that you're involved in and why you're actually doing it. And people are, that world is optimized around P&L, right? And how much money you make. It was amazing to come into the digital assets ecosystem in 2018, where there were a lot of bright minds with I'm very mission driven of how do we do this better? How do we improve the financial system? There's a better way of doing this. We can, first principle thinking, we can challenge the way that the industry works currently. And of course, as it's matured, there's been a rush of people coming in that are looking to profit from the industry, of course. But the core thesis behind it was people trying to sort of improve financial markets and make things better, and actually think about why financial services exists as a thing. And I think I found that very energizing, I guess, to work in.
Yeah, I mean, like, financial industry is wrapping all the other industries, right? Because it's everywhere. And let's since we've touched the tokenization, and like there's been a lot of discussions about RWAs, like it's been there for many years, but there's one specific tokenization case which is over the roof. I mean, it's like now proven to be the most successful real world use case of crypto as of today. It is the stablecoins, right? And we've been also on the Finery Market side there, like preaching for the actual real world use case, like on the payments, the money remittance. And now it seems that everyone, like being a bank or a payment company, wants to launch its own stablecoin. And it is like JP Morgan is, I guess, suggesting it will reach like a few $1 trillion market. So how does that stablecoin boom impact your business, and what are your things on that?
So overall, I mean, it's great. And I think it was really important for the asset class in general, because one of the criticisms of the asset class is it's a solution searching for it's a problem searching for a solution. I butchered that. I butcher analogies in general, but you know what I mean. I think we now have two broadly understood use cases of blockchain crypto that has permeated financial services and maybe the broader economy. One is Bitcoin as hard money, particularly in the inflationary world that we live in, and the other is on-chain fiat through stable coins, and using the Ethereum network, the Tron network, as an alternative to the banking system, SWIFT, correspondent banking, etc. And I think particularly, look, if you are in a sort of major Western economy with good banking rails and you're trying to send payments within that country, of course you're like, I don't kind of get the use case because I can send money to you instantly and our banks sort that out. Cross-border payments, if you're in emerging market countries, the use case is clear, right? So that overall is very good for the industry, that we now have two very clear use cases. I think that we as a business have built the ability for clients to buy and sell Bitcoin and Ether and the kind of base assets in crypto. We have built the ability for clients to speculate and hedge themselves through derivatives on these products. And that's generally what we do. We offer access to the underlying, and we offer the ability to hedge and speculate on them, which is a kind of core part of financial services. So we've got that in place now. And now I think in terms of end customers that we can serve, people that are looking to sort of switch between systems. I want to, I have most of my money in fiat money. I need to now get stable coins to be able to do all the things you can do with a stable coin. That is going to be something we are starting to see more and more demand for. So yeah, it's been really important, I would say, for our business in general.
Yeah, and overall benefiting, I guess, right now, every single person can now get access to that crypto benefits with just better fees whenever you pay. And actually, I wanted to share one personal experience which I faced a couple of weeks ago, which I'm kind of extremely proud of. Is there's a famous wine shop in London, in the Mayfair area, and my brother had a wedding a couple of weeks ago, so I actually purchased some champagne, and I walked into the store and I asked if they do accept crypto, which eventually they do. And I decided to pay from my self-custodial wallet. And literally, like, they given me a POS terminal, which was specifically like for crypto. So I scanned the QR code, I sent USDTs, and then instantly I saw that trade was hedged of like USDT against GBP via Finery Markets. So I saw this entire life cycle, and I paid through my self-custodial wallet of a company that I also sit on a board with. So it's kind of the entire life cycle through like actually purchasing something. And I clearly see that the fees that was charged on the FX were way less compared to like whatever Visa was charging just for the same thing, but outside of crypto. And the speed of that transaction was the same as you would pay just with your regular debit or like a credit card. So to me, it was like this moment of epiphany that this is it. This is the real world use case where I can easily pay with that. I can save on the costs, and basically the business also saves on the cost because they don't need to pay those, enormous fees to like all the layers of traditional infrastructure. So
Yeah,
it's quite exciting.
that is very cool. And in addition, I would emphasize your point there, like that is great for the merchant and their ability to save fees, and
Yeah,
more of the profit is going for the service that they offer to you, which is curating and offering
100%.
great wine.
100%. 100%. Nice. So like let's try and like wrap it up, and we have our usual question is if you would recommend a couple of books to all of our listeners, maybe something on the professional side of things and one on the more of a personal level, what would those books be?
Oh, good question. So I think the one that I found most relevant to what we're doing at TP ICAP was a book by Clayton Christensen called The Innovator's Dilemma.
Yeah.
It looks at sort of the balance between incumbents and startup innovators, and their relationship in terms of sort of disruptive innovation. And it was actually gifted to me by a friend, but that's been useful as I guess, for want of a better term, an entrepreneur thinking about how we build a business within a large organization that is an incumbent in financial markets, and typically more optimized around, not taking too much risk because we have a entrenched position in financial markets, and challengers that can take more risk, build faster, and are trying to eat our market share. So I found that one very interesting. Another that I think people should read that are involved in crypto and digital assets, but a bit more controversial, make your own opinions about it, is The Sovereign Individual. I don't know if you've come across that.
Not yet.
But it's a book about how this information economy that we're in
Yep.
is going to change the way that sort of we organize ourselves as a society, and the way that we, general governance, and the rise of kind of these sovereign individuals. It's definitely, there's some fair criticisms about the elitism of the book, and but it's very thought provoking. And I think if you work in the industry, it's great to get you thinking
Yep. We'll
about
definitely add this one
the
into
direction
the
of travel. On a personal side, what would I say? I suppose I can probably can't. I can give you a slightly different answer, which is what was my favorite book growing up. I was definitely into science fiction as a kid. My favorite book was probably Dune by Frank Herbert.
Nice.
I think I loved, I think as a Yeah, there's definitely an element of sort of heroism in there as a young male that sort of appealed to me. And I think, one of the things that I've learned as I've, come into financial services and with my colleague kind of started a business here, there's definitely an element of challenging yourself and trying to build something new and do something new. But what I've actually come to realize, and I'd be interested in your thoughts on this as well, like some of the most rewarding things in terms of building a business is actually like the kind of relationships you develop with people and seeing people that you work with, succeed and become, achieve things that they didn't expect, which is not, I guess, what I was thinking about or optimizing about when I was a young professional starting in the industry.
100%, and especially in our industry, like I truly believe that financial industry tends to accumulate like world's best talent, because this industry is once again wrapping up like all of the other niches. So when you actually have the privilege of talking to all the brightest people that are involved in like all the different aspects of the industry, that is just great, growing together and building great products together, and also see how not just the industry matures, but the people around you. And I think, it's a great privilege to be working in the space.
Side point, the Dune movie was probably one of my favorite moments in time because it combined Denis Villeneuve, one of my favorite directors, and actually I'm a big fan of Timothée Chalamet as an actor. So when that came out and it's like Dune with Denis Villeneuve with Timothée Chalamet, I was like, oh my god. And it delivered as well. It was a fantastic movie. So
beautiful. Yeah, I think this is a perfect wrap up. And Duncan, I really enjoyed the conversation. Thanks a lot for coming.
It's been a pleasure. Thanks for having me on.
Thank you.